In this video, we will be discussing Chapter 16, Section 2, What does the Federal Reserve do? So up to this point, we kind of figured out the structure of the Federal Reserve, the structure of a Federal Reserve Bank, and the structure of a FOMC. Now we're focusing on what are the actual purpose of the structures for the Federal Reserve. So one of the biggest things that they're responsible for is clearing a check. And what that looks like is if you write a check or if you receive a check, it's not instantly cash. What needs to take place is, let's say you're writing a check to someone else, and you write an amount in there for $50. They take that check, they bring it to their bank, deposit it, and then what takes place is a process. And the process basically goes that the bank will take all their checks, send it to the Federal Reserve, and then it would go to the bank that is your bank to check to make sure the funds are in there or to clear the check. If it is clear, then those funds return back to the Federal Reserve and then they return to the account. So if someone ever writes you a check, usually you don't get the cash instantly. They may give a percentage or a smaller amount depending on how large the check is. But usually, though, you will not receive the full amount because it has to clear the other person's bank first, go through the Federal Reserve, and then it goes from there. All right, so how does the federal government, Federal Reserve, serve the federal government? Well, we're looking at it as a bank, and the Fed is nothing more than the banker, and the Treasury Department is the checking account. And the Treasury Department issues checks for Social Security, income tax refunds, other government payments, anything that's related to paying debts, things like that. The Treasury Department is really the one that holds the money, that sends the money out. The Federal Reserve Bank of New York is the one really responsible for a lot of these transactions that take place. And then they control the currency. That is the amount of printing. The U.S. Mint creates the coins or creates coins. We also find T-bills, T-notes, bonds that go through them. And again, they're kind of like the whole banker through all this. So they're the one issuing all these things. They're also taking things in, different types of income and debts and all of that. So they're really controlling the banking of the federal government on how they spend and making sure they stay within their bounds. All right, so I already kind of mentioned this, but how does the Federal Reserve serve member banks? Well, the number one thing is, again, check clearing. When you write a check to someone, that member bank sends that check into the Federal Reserve. Federal Reserve sends it to the other bank, make sure that the funds are in there. If the funds are in there, then it's returned back to that member bank. On average, the Federal Reserve clears 49,315 checks per day. And this is people's payroll. This is their paychecks. This is payments that they're doing. Everything's getting cleared this way. A lot of people are moving away from checks because we have electronic transactions we can do now. But check clearing is one of the biggest things that they do. Also, they monitor the amount of money that banks have on hand, known as bank holding companies. They want to make sure that they always have enough cash available, currency available, for the transactions that happen throughout a day for a bank. Another thing that the Fed does is they make sure that these member banks are using truth in lending laws. What that means is that the bank is giving accurate loan terms for its customers. They're not lying to their customers. They're not signing them up for things that they didn't sign up for. So Wells Fargo is a member bank of the Federal Reserve, and Wells Fargo has been in big trouble lately. And it's been a little while now, but what was taking place is a lot of their tellers and their bankers were working together to create accounts that were not really opened up by their customers that are at that account. So let's say you have an account at Wells Fargo, you have a checking. Well, maybe they would open up a savings account without you knowing. The Fed is responsible to monitor this and make sure there's truth in lending laws that things like this don't happen. As a result, Wells Fargo was hit with some major fines. They took away all commissions that they offer their employees anymore, so things have really been restructured for Wells Fargo. Another thing that they check is bank mergers. This has to be approved by the Board of Governors and to make sure that the findings and recommendations are correct, and also make sure the competition stays in competition. So if US Bank and Wells Fargo wanted to create a merger, they would have to get that approved by the Board of Governors. Alright, so how else do they serve member banks? One of the biggest things is lending to banks when in need. So we have something called a federal fund rate. So a member bank has two options on what they can do here. So let's say it's Christmas time and they're getting a lot of money at this one bank. It's just being withdrawn, and they're getting very low on the amount of funds that they're required to hold at all times. What they can quickly do is a member bank can do one of two things. They can contact another member bank, and this would be known. They would do this again to make sure they have enough funds for their bank. Now, the rates that banks charge each other, member banks charge each other in the first example here, is called the federal funds rate. And these are interest rates that banks charge each other for loans. So if Wells Fargo needs to borrow from another Wells Fargo bank, they could charge that fee. Or if they need a completely, let's say there's an independent bank that's just a small bank and they don't have enough, they could go to another member bank and then they could get cash quickly, and then they'd be charged a federal fund rate. Another thing that they can do is these member banks can tap into their Federal Reserve, and this is known, the interest rate that the Fed charges a member bank is called a discount rate. And so they can charge that amount too. So these member banks have options. They can go to other member banks, they can go to the Fed, whatever they like to do. And then also, they serve the member banks by buying debt from corporations and extended loans. So this is important as well, because if we're heading to recession, the Federal Reserve can step into the banking industry and buy up a bunch of debt from these corporations' extended loans, which then boosts the confidence of the customers of that bank, which will then stabilize. So the whole idea is that the Fed has a certain amount of money set aside that they could buy up this debt and then hold on to this debt for a while. Once the economy improves, well, then the Federal Reserve then can have the bank buy it back. So they have this relationship to make sure that things are staying confident in the economy, and financial institutions are able to stay open without closing. So again, banks can help each other out, or they can go to the Federal Reserve. One of the number one things why we had the Fed is to monitor the banking system. And as we already mentioned, each bank is required to hold a certain amount of reserves. And then also these banks can be audited. A bank examiner would go to the banking industry, it's usually a team, they'd open up all their financial records and books, and then they would monitor to make sure that bank is doing things correctly. If the audit fails, this would result in more audits taking place at that member bank, and then also there would be fines. And as mentioned, when Wells Fargo started messing with the numbers and creating accounts that didn't exist, Wells Fargo began to get audited more often than not, because they were doing things that were illegal. So they regulate to make sure that everyone has their certain round of reserves, and then they do bank examinations. One last thing on the certain reserves. Remember we talked about the Wildcat era, and no one was checking up on these banks that would show up in town? This takes care of that problem to make sure that things are being done correctly, and also that they have enough cash on hand. And lastly, the demand for money and stabilizing the economy. So this is where the Federal Reserve really has an opportunity to help make things stay more stable. So if interest rates are high, generally people will keep their wealth in assets. That's bonds, stocks, savings accounts. If interest rates are low, people tend to go out and spend more cash, having a higher demand for money. So if there's a higher demand for money, this is where the bank can help with that money supply. The Reserve can help with the money supply to make sure there's enough. Now, as soon as the interest rates begin to increase, well then this is where the money supply would begin to decrease because people are not as likely to go out and spend money on major things. And that's where they would take that money that they would rather spend out in the economy, and then they would put it into wealth assets as far as bonds and stocks and savings accounts because they can get a higher return that way. So when you're making your investment ideas of what to do, interest rates are low, people are going to buy more. Interest rates are higher, they tend to invest more in assets and hopefully get a better return. So it helps stabilize the economy. If there's high inflation rates, well then the government can step in and print more money, and then as a result of that, that would draw down the interest rates. If GDP is going too slow, well then the GDP can increase by providing more cash as well, or providing opportunities for investment. This is the end of Chapter 16, Section 2, talking about the purpose of the Federal Reserve.